subscribe now and press the bell icon. Never miss an update.
Now we're going to start on business property transaction. This is going to be a bit difficult chapter. It could be a bit confusing, but pay attention. Read it. Stay in the class with your full concentration, and I'm sure we'll be able to do that. So now, whenever a business property is sold, the capital gains will come into the picture for sure, but the treatment of those gains can be done differently, because those are business properties. Some point of time in the previous years, we must have taken advantage of some kind of deduction on those properties, either in the form of amortization, depreciation, some other credits, something else. So these are business properties, and the rules are very different for business properties than the individual property. Okay, when we are talking about recharacterization, this is the word that you will see a lot. Recharacterization. Recharacterization means characterizing them differently, putting them into a different tax bracket. And it's quite possible that that gain, even though it's capital gain in nature, it may still come as an ordinary income in the tax return. So that would mean that we are paying taxes at a high rate because it's considered as ordinary income, not a capital gain income. When does that happen? What are the properties considered to be business property? How are they classified? Can personal property such as laptop or furnitures or these property machinery, can that be considered same as buildings or structural structure, some kind of structure which has been built up again, like in your office or in the factory area or somewhere, right? So we'll have to understand first. What we need to do is there are three sections which are very important: section 1231, section 1245, and section 1250. These three sections are very important, and whenever we are working on capital gains or whenever we are working on sale of a business property, the software will ask us these questions. Is this a 1231 property? Is this a 1245 property, 1250 property? At least we should have that basic understanding that we put those properties in the correct bucket or in the correct place. If you mark 1231 property as 1245 or 1250 and all, then the calculations will not be done correctly. We are still not manually doing any calculations, but we need to understand what is going behind that. Why is it important to characterize them properly? Okay, so let's let's start this, and we're going to go a bit slow here so that we are able to grasp all the concepts well. Okay, let me open. Can you see my screen again? It's a PDF now.
Yes, ma'am.
Okay, let's look into this example. Is very good example. The way it has been picturized here is it will help us understand. An overview of business property recharacterization. Recharacterization meaning depreciation recapture. Something has to do with depreciation. The moment we talked about business property, we are not talking about inventory or receivables or any current property, like current asset kind of property, because there's no depreciation there. We're talking about fixed assets or other assets which could be depreciated or amortized and all. So that's when all these rules come into the picture. Section, and it's very important because it can completely change your tax computation. Depreciation recapture, if it's happening at the ordinary income rate. Okay, and not at the long-term rate. So let's look into section 1231. That's long-term business property. Any property which has been held for more than 1 year And it's usually any kind of depreciable property or land or immovable property, everything will go under that, but it has to be a long term property. Then this has been put up into two different sections, 1245 and 1250. 1245 is any depreciable personal property. It could be immovable properties, it could be machinery, it could be furniture, it could be something else. And 1250 is mostly it's only real property. That means building or structures or something which is attached and not movable and all. So we have to differentiate between if it's a personal property, personal meaning not like personal in the sense that this is your own property, it is still a business property, but they call it as personal property. And this is a real property, which is affixed to the land, real estate, it cannot be moved. So we have to see what is the depreciation. The long term rate can come up to anything, it could be 0, 15, 20% and all. For C corporations, usually there is a flat rate of 21%. There is no long term, short term for C corp and all. But it's quite possible that there could be that for LLCs, for partnerships. So we'll have to pay attention to that. Any excess gain over depreciation is 1231 capital gain. 1231 is usually what we need to remember is like whenever section 1231 we are talking about it, it will usually give us the most the most benefits in terms of taxes, because everything is coming up as 1231 capital gain, meaning long term capital gain, which will get taxed at a lower rate. But when we are talking about depreciation recapture, then immediately it should strike in our mind depreciation recapture, meaning it can be considered as ordinary income. Okay. Again, there is another very good picture example. Section 1245 property. Somebody is like this person, this animal or whatever has been caught in the cage, and this guy is saying you've been recaptured. And these people, these creatures, they're saying, I feel so ordinary. This is a great way of remembering. Whenever there is a recapture, it will come up as an ordinary gain. Does that make sense? Does that make it easy? Because they've been put behind the bars or put in a cage, they say, oh, I feel so small, so ordinary and all. And this guy is saying, because you've been recaptured. You're not going around, freely moving outside anymore. Okay, so that will help us understand whenever there is a recapture, there is a possibility that there will be ordinary gain will come into the picture. Okay, let's go over our material now. So let's see what is section 1245. A recognized gain on the disposition of section 1245 property is ordinary income to the extent of all depreciation or amortization taken. This is more or less like we should remember this rule. Wherever there is a depreciation, amortization, and if we are selling that property, any gain to the extent of depreciation or amortization taken will be considered as ordinary. Okay, amount expense under section 179. Section 179, it is considered as depreciation only. We put it separately like section 179 expense or section 179 deduction. But actually what it does is it just accelerates your depreciation. It's again one of the benefits that has been given by the government to business people or businesses, that if they go and invest, make some capital investment either in plant machinery or buy some property or stuff like that, they can take the entire expense as a write off in the very first year. So that's amazing. Typically it will take up to 7 years or 10 years or even 20 years to write that off. So that's such a great benefit to the businesses. So what that does is basically the idea is to encourage them to invest more and more in the economy. Right, so if they know that, oh yeah, I'll be able to take $1 million of expense deduction immediately, or 400,000, 300,000. Fine, let's go ahead and spend that money. At least 21% if it's a C corp, or 25% if it's something else, or maybe 30% may come back in the form of tax benefit. Property is considered placed in service when it is ready. That this is again a simple rule that we should know. It doesn't matter when the property has been bought. When do we start depreciating? When it is placed in service. There could be a time difference. There could be few weeks, few months, maybe a couple of years or few years time difference. Doesn't matter when it was bought. When it is placed in service. So whenever we are, using that fixed asset module in our tax software, it will always ask the question: date property was placed in service. It never asks what is the date on which you bought the property. So depreciation has to be calculated from the day it was placed in service. Any basis adjustment for a general business credit, any, a lot of times we get a business credit like energy credits if they try to do some energy efficiency renovation or put some solar panels or wind mills and stuff like that. uh, you know there are a lot of energy credits that a business can claim, or any huge R&D expense which is capital in nature and business is claiming R&D credits. So that's all possible. So what we have to do is we have to do a basis adjustment. We have to consider that some kind of benefit has been taken up on that expense in the past. So now when we are selling that asset, we need to see if that is um, if that is prone to recapture rules. Okay, so let's go over what is section 1245. Property is generally is a depreciable personal property used in trade or business for over 12 months. This is what we can make your notes. You can write down section 1245 is a depreciable property. It's a personal property. It's not real in nature. It's not a real property. It could be tangible, intangible, depreciable. It could be an equipment. It could be a patent. It could be any recovery rights that we have, or any other kind of property. Other tangible property, excluding a building or its structural components. So that is being excluded. That is being excluded from 1245. But any other equipment or some machine has been put in to manufacture something or do some quality testing and all, it could be pretty much fixed to the ground. It could be practically not movable and all, but still it will not be considered in the category of building or structural components. Any intangible, amortizable and all, these are all examples of section 1245. Okay, so even goodwill, patents, livestock, any contracts would also have a value. It's not like they're sitting on the paper, they don't have any value. The contracts may have a big value. Patents, we don't see any patents, but again, that's on the paper that some right has been given to your company that, okay, you can only manufacture that kind of product or use the technology. So again, these are all intangibles, but they will all fall under 1245. Okay, so we'll go through one of the example how to differentiate between 1245 ordinary income and 1231 gain. Okay, so Muskan, can you read that?
Section 1245 ordinary income and Section 1231 gain. Page owns a patent to the cost of $300,000 and an adjusted basis of $260,000. On January 2 of this year, Page sold the patent of $345,000. Total amortization taken previously equals $40,000, that is $300,000 less $260,000. Page's realized gain is $85,000, that is $345,000 sales price less $260,000 adjusted basis. Section 1245 requires the gain to be recognized as ordinary income to the extent of the amortization taken. Therefore, $40,000 of the $85,000 gain is Section 1245 gain, and the remaining $45,000 is Section 1231 gain.
So what is happening is section 1231. Let's remember this in our mind. The section 1231 will give us the highest tax benefits. So Tanya, will you be able to explain this?
So the cost of the property is 300,000. The adjusted basis is 260,000. So
Okay.
the depreciation claimed on the property is 40,000 from here. The
Right.
gain on the total property is 345 minus 260, the adjusted basis, which is 85,000.
Right.
Out of this 85,000, the 40,000 depreciation that you have claimed is actually going to be your section 145 gain.
1245.
1245, and the remaining 45,000, that is 85,000 minus 40,000 of depreciation, is going to be your 1231 gain.
4797 or something. I can't remember, but then are they talking about it here somewhere? I don't know.
4797, correct.
Right? Sale of business property
Hmm.
form 4797.
Hmm.
Somewhere they should be mentioning that. I don't know if they do it or not, but yes, that form, whenever there is a business property which is being sold, immediately we need to make sure that that form is included there, and all these adjustments will show up on that form. And business property, even Schedule E property will be considered as business property because that has been used for business. Business doesn't necessarily mean that you have to incorporate yourself, or you need to make sure there is a full business kind of structure that you have put in and all. Nothing like that. So even rental property, which is Schedule E property, can also be considered as a business property because you're making money out of it. So these sections will be applicable: depreciation, recapture, and all. So is everybody clear on this? Okay, see how the ordinary income and 1245 gain is considered as ordinary income. So 40,000 will come up at a higher tax rate, and remaining 45,000 will be considered as long-term capital gain, which could be anywhere from 0% to 25%. Okay, I hope we are clear on that. So we'll move to now section 1250, ordinary income. Okay, so we knew what is section 1254. It's all real property. Okay, what they have done is all property they have divided into two different sections. One is section 1245, one is section 1250. So, such as building and structural components and all those things. Now, these rules can be a bit confusing, and it's not expected that you remember all these rules, but at least we'll go over them. Section 1250 property is subject to its own recapture rules. For the three items listed below, these are the three items 1, 2, 3. For these three items, the aggregate gain recognized on the sale or disposition of Section 1250 properties ordinary income. Any of these three, if they are coming to be true, then this is considered as ordinary income. Okay, let's see what are those things. So first, what they're saying is any excess of accelerated depreciation taken over straight line depreciation. Straight line depreciation is allowed, what they're saying. I mean, the other accelerated depreciation is also allowed as far as tax is considered. If you have taken a deduction, that's fine. But when we are talking about what is Section 1250 gain, what IRS is saying is, have you taken any accelerated depreciation earlier? If yes, for let's say last 5 years you're taking depreciation on some accelerated rate. There are a lot of depreciation rules where you don't have to go with straight line method. So the meaning itself says accelerated depreciation, meaning you have taken more. So what IRS is saying, whatever you have taken extra on top of straight line, that will be considered as ordinary income. Okay, and this is very uncommon because typically real estate property and all, they we usually 99% people like businesses have been taking straight line method. But it's quite possible they must have taken 179, section 179 advantage and all. In that case, we'll have to see. Like after 5 years, if you're selling, then what should be the depreciation for 5 years, considering straight line method? And what is that you have actually claimed on your tax returns? Difference between those two will come up as ordinary income. So for corporations, the gain must be computed under both sections, and section 1245 is larger than 50. Sorry, section 1250, then 20% of the difference. So what they're saying is you use section 1245 rules also, section 1250 also. Even though this is real estate, we are actually should be using only section 1250 rules. But just this is just done in order to see what should be charged as ordinary income. They're not saying that you go ahead and change all your method. You don't go with accelerated depreciation. You should just stick with straight line. This is nothing that they're saying. They're just saying that if you have done that, we have to see what is the difference. If you're a corporation, you do your calculation using both the sections and see whose gains are larger. Wherever there is an investment on long-term basis, like meaning they're holding it for more than 12 months, they are trying to give all the benefits. But if it's held 1 year or less, it's straight away saying, okay, fine, like, we don't care. Like, we expect businesses to make long-term investments. So if you're doing something short-term, just take the entire depreciation and put that up as ordinary income. Okay, there are certain examples, shopping malls, apartment and all, they will all come under 1250. Any income received or accrued for more than one asset. Again, we have seen this rule earlier that if the income is coming or accrued from more than one asset, then either we have to apportion that income by using fair market value method, or we need to use residual method, and we need to see what income is attributable to which asset. It's possible that like there's an apartment complex, there are a lot of apartments there, maybe some of them are 2 bedrooms, some of them are 3 bedrooms, some of them are penthouse. So how do we know, like when you are selling it off, let's say you're selling like 5 2 bedroom apartment, 10 3 bedroom apartment, how do we know what to allocate to which one? So what they're saying is you use the fair market value method and then try to apportion the income. Okay, that's all fine. Let's see what is unrecaptured section 1250 depreciation. Okay, so let's just see. Let's go over this little slowly. It only applies to individual taxpayers. Unrecaptured section 1250, and only if there is a gain on the sale of asset. Okay, so if there are individual taxpayers, then we'll talk about unrecaptured section. Recaptured meaning you have recaptured somebody, and then you remember that picture? I have been recaptured. I feel so ordinary. So recapture meaning we are taking it back as an ordinary income. Unrecaptured, if there is some depreciation which is not being captured. But again, what they're saying is this rule we will apply to only individual taxpayers. And only if there is a gain, if they're selling a property, there is a gain. If it's an individual person, we can take advantage of this rule. Okay. In case of multiple section 1231 assets, this rule applies only if there is a net gain on the sale of all assets. Like there's more than one asset, just making it more complicated. I can understand that, but don't get very overwhelmed with all these things. These are simple rules, still simple rules. What they're saying is if there's one asset, what do you have to see? There has to be a gain on that asset. But what if there are multiple assets? What if there are 10 assets that we are selling and five of them are giving gains, five of them are, leading towards losses? Then what they're saying is you net off all the gains and loss. If there is a net gain, and if multiple section 1231 sales net to a loss, then that loss is ordinary. But this is why section 1231 is a tax beneficial clause for the taxpayers. The lesser of the following is taxed at a maximum capital gain rate of 25%. Maximum rate that you can do is 25%. Um, any excess gain is allocated to net section 1231 gain, and it could be taxed at 0%, 15%, 20%. So lesser of these two, gain on the sale of asset, less any depreciation recognized as ordinary income, whatever that could be. Lesser of these two, either we have to take into account this, what is the gain of the asset, less any depreciation recognized as ordinary income. If there is no depreciation recognized as ordinary income, we just take what is the gain on the sale of the asset. Any accumulated depreciation on the asset, okay, less any depreciation recognized as ordinary income. This thing is common, any depreciation recognized as ordinary income, but we'll have to take lesser of these two, and maximum is like 25% they need to pay the tax. Let's go over this.
Annie sold a building used in her trade or business for $110,000. This is her only Section 1231 property sale for the year. Annie purchased the building
So
several
again,
years
what they're
ago.
saying is this is her only section, so don't get confused between clubbing all the different properties and all. This is only one property. Let's keep it simple. She has one property, which is the building. So when it is a building, what section will come into the picture, Sakshi?
1250.
Perfect, 1250. So when it's a building, we know, and it has been used for business. So again, that becomes a business property. And this is our only asset. So we are not worried about like netting of all the different multiple section 1231 and all those things. Okay. Yeah. Continue, please.
Annie purchased the building several years ago for $100,000. At the time of the sale, the building has accumulated depreciation of $20,000. The building was depreciated using a straight line method. Section 1250 recapture does not apply, and Annie has Section 1231 gain of $30,000. $110,000 amount realized less $80,000 adjusted basis. Of the $30,000 gain, $20,000 is attributable to straight line method depreciation and is classified as 1250 section unrecaptured gain, which is subject to maximum rate of 25%. The remaining $10,000 gain is taxed at the maximum rate of 0 or 15 or 20%.
Okay. Shweta, do you like to give it a shot? Would you like to explain it?
Okay.
See,
So the building,
one of the things I just want to tell you before you go through that, they're talking about unrecaptured gain. Okay. That means we are not taking that as ordinary income. But there was a depreciation component involved. Okay. And this is section 1231 property. It is supposed to give benefits. Typically, whenever we are talking about section 1231, like that's the best tax strategy that one can have. Okay, sorry, go ahead now.
okay. So the building that was sold was for $110,000, which had a cost of $100,000, and 20,000 was accumulated depreciation. So the adjusted basis is 80,000. Now there's a gain of 30,000, that is 110,000 sale value minus adjusted basis of 80,000. So that now we have to bifurcate this 30,000 as 1250 and 1231, right?
Correct, correct. So no, so this is okay. there's one more thing that we need to pay attention. This is an individual selling, it's not a business. Okay, so this rule is applied to individual only. If it's a business, if there's some ABC corporation selling a building and all, we will not go with. This is giving her a lot of advantage. What is her gain? 80,000 less 110,000, right? 80,000 was the basis.
Yes.
So 30,000 is
30,000.
the gain. Out of that 30,000, how much did she use? Did she take advantage in the prior years and took as a deduction?
So 20,000 was accumulated depreciation.
20,000 was accumulated depreciation. So what they're saying is that 20,000 will be taxed at a maximum gain of
25%.
25%. Otherwise,
That
it
would
would
be
be
taxed as
recaptured as ordinary income. But here they're getting an advantage that maximum, even though her tax rate might be 35% as an ordinary, in the ordinary rate. But she's going to pay maximum of 25% on this 20,000, which is a unrecaptured amount. The depreciation is not coming up, as it's not getting recaptured as ordinary income.
also because she followed straight line method of depreciation, right?
Yeah, exactly. And she also followed a straight line method. So maximum she'll be paying is 25%, and the remaining gain she'll be paying any of these rates depending on her AGI and tax slab and which bracket she is falling under.
Okay.
1 minute, let me just see if we can go over this picture. What are they saying is best of both worlds. Best of both worlds. This is definitely one of the best sections for the taxpayer. I treat losses like ordinary losses. So section 1231 business assets are truly best of both worlds because they treat losses as ordinary losses. This is a great thing because a lot of times we see passive income, it just keeps sitting there, it will get carried forward. Even though passive losses, even though there is a huge loss of $100,000, $50,000, still taxpayer may not be able to take advantage because it's passive in nature. Or something might be capital losses in nature, maybe $1 million of loss. Practically they lost everything that they earned. Still, they'll have to pay taxes on the salary income because capital losses cannot offset salary income. But here, Section 1231, they're saying this is best of both the worlds. Section 1231 losses will be considered as ordinary losses, able to offset ordinary income. And the gains will be taxed at preferable capital gains tax rate. So the gains will be considered as capital gain, which is definitely going to be taxed at a lower rate because these are capital gains. And if there are losses, they're considered as ordinary losses. This is like best of both the worlds. That's what they're saying. Okay, I treat losses like ordinary losses. It's easy to understand. It's just that there are too many new terms, so we may get lost. Like what is 1245? What is 1250? How do we do? What is unrecaptured? What is recaptured and all? But it's basically, if you understand the concept, it's very easy to follow. Okay, so we'll stop here now, and tomorrow we'll continue with section 1231.